Lyon Share Podcast with our host, Ed Lyon. Ed, Happy New Year, and we have an amazing guest today, don't we?
Happy New Year, and we've got a terrific returning guest and we've got a terrific topic, although it may not be as glamorous as some of the other things that we talk about. It's really important. We talk a lot about saving money on taxes, but there's a lot you have to do. So my guest today is Paul Channo. He is an enrolled agent from Michigan. He is 26 years old, which is pretty unusual in the tax field. He's also a brand new author. So, Paul, welcome back to the show. Let's dive right in. First of all, looking the bottom of your image here, and you've got some initials after your EACRETS. Why don't you tell me about those?
Sure. And thanks for having me, Ed. I appreciate it. I hope you had a Merry Christmas and a Happy New Year. I'm an enrolled agent licensed through the United States Department of Treasury, and I am a certified real estate tax strategist. One of my real estate tax mentors, Natalie Colati, created this credential. It is currently the only credential that a real estate tax professional can take, whether you're an enrolled agent or a CPA. This is the only one that's out there, and it's a great way to really make yourself unique in the real estate space as a tax professional.
Okay. So you're leading directly into my first topic that I wanted to discuss, which is what is the difference between an enrolled agent and a CPA? I bet most people think of you as their CPA, don't even understand the difference. So why don't you talk a little bit about how those are different and how the enrolled agent credential positions you specifically as a tax guy?
Sure. Now, in the IRS's eyes, there's really no difference between the enrolled agent and the CPA because both licenses are considered fully authorized tax professionals who can represent taxpayers in front of the IRS. Both are up to the IRS. They cannot go to tax court or any other court for that matter. But the real difference is really how you get there. Now, of course, with the CPA, you need a bachelor's degree, some firm hours, or a master's degree, if I'm correct. And then there's a pretty rigorous examination, but that's not limited to tax. There's many other subjects that you can take. I'm not too familiar with it, honestly, since I'm not
in
a
fact, it's not even primarily tax. So the
right.
CPA exam consists of 4 segments. One of those 4 segments has, as part of the tax regulatory environment, that's where they're talking about tax. But a certified public accountant is accountant. You're studying rules, you're studying cost accounting, managerial, all that stuff. It's really just too awful for most mortals to contemplate.
And there's a huge shortage right now coming into the industry, whether you're a CPA or whether you're an EA. No one's coming into the accounting tax space. And if they are coming into the accounting space with a CPA, they want to do auditing. I have plenty of CPA friends who just hate tax with all their lives, and they just want to stick to auditing, working at Deloitte and firms like that.
So why is that? Why on earth would people hate tax? It hurts my heart.
Well, what I don't understand is why someone would hate tax but do auditing. I think that's much more boring from a day-to-day point of view. But I think people don't like tax because they hear the word tax. They've never learned it before in grade school, high school, even college, really. And they just don't want anything to do with it. Even attorneys who go to law school, they take a very basic gross income class, maybe another business income class, and they never want to do tax again. They want to stick to their lane and whatever specialty they do, whether it's injury or something.
Sure. And when I went to law school, I had no interest in tax. I wanted to be a prosecutor. After a couple of criminal law classes, I realized that, at least at the law school level, criminal law classes are an exercise in getting the guilty person. And it's an important part of the criminal justice system, adversarial stuff. I decided it wasn't for me, but I would tease classmates who knew they wanted to do tax as somebody who wanted to go into something pretty boring. Finally took federal income taxation, third and final year of law school, and loved it. Estate and gift taxation the next semester, loved that as well. It's intimidating on its face. I wonder how many parents like me would steal a French fry off the kid's plate, call it French fry tax.
Or the dad tax. I'm sure you know that one.
Right. The dad tax, the mom tax, and they grow up taking tax until my kids got old enough to know that all of the financial support in their lives came from the tax business.
Of course.
So, enrolled agent, CPA, it's not accounting focus. Do you know the origin of the enrolled agent? How
Not
that
too
designation
deep. I know the IRS has been giving it to their employees. I don't know the history of it, to be honest.
So just a little, and this is more trivia than history. The enrolled agent designation started right after the Civil War when soldiers went to the government to get compensation for horses they lost in the war. And the enrolled agents were the ones who were licensed to negotiate with the government to get compensation for the horses.
Wow. Sounds like a great story, honestly. Much better than CPA, I think. But,
Oh,
um,
much better story.
So,
Much-
yeah, I'm trying to figure out what an enrolled agent is because
Yeah.
I understand the CPA. Everyone hears it. That I always think of CPA, and this is me again, layman as heck. No idea, except I'm learning a lot about taxes in the last year, starting with Alan Porter up to you now. And I'm like, oh my gosh, I'm really getting an education in this. To not be afraid of the IRS. Wish I would have done things when I was younger differently. Definitely quit my job earlier to know that and understand ultimately about it's not how much money you make a year, it's how much you keep.
Right.
And these are not taught. You look at what does our W-2 look like or what is our end of things. So when I think of a CPA, I think of a highly professional person who prepares taxes as a CPA, meaning they have all the skills versus somebody who isn't licensed. That's how I define CPA. Am I wrong about that or?
I wouldn't say you're wrong about that, but there are about 50,000 enrolled agents in the country, which is a pretty substantial number. There's 660,000 CPAs. If you assume the average CPA is 5'8", you lay all 660,000 head to toe. They will stretch from Grand Central Station to suburban Atlanta. Not all of them, even a majority of them, are working on taxes. You have a lot of CPAs working on the audit side, big accounting firms. You have a lot of CPAs who are working inside private companies, taking various accounting roles. You have a lot of controllers and chief financial officers who are CPAs as well. It's a minority of CPAs who do tax, an even smaller minority who own their own tax firms, are doing taxes for people like Lyon Share Podcast listeners. Enrolled agents tend to be individuals operating individually or in small firms. There's no big four of EA firms. But Paul, tell us how one becomes an enrolled agent and why the tax credential is more valuable.
Sure. Now, the Department of Treasury federally authorizes this license. That's the main difference between the enrolled agent and the CPA, which is administered by the state. Now, when you want to become an enrolled agent, you have to take 3 exams. The first exam is all about individual taxation, including estates and trusts. The second exam is all about business, corporations, partnerships, all of the dirty stuff, all of the nitty-gritty, everything you can think of. And then the third exam is more about representation and penalties, really making you aware of what you're actually doing and what the cost could be if you're performing in malpractice.
So let me translate representation. Representation means you and the IRS are in a dispute. It's rock'em sock'em robots between you and the IRS. So the enrolled agent really is the front line. I'm going to use the word litigator for the client with the IRS. So it's going to involve negotiations. It's going to involve preparing those reports. It's going to involve educating auditors about the client's tax situation, about the client's overall financial situation. This is who you're going to you can engage in. For example, if the IRS says you owe $140,000 and the client says it's empty, $140,000. So today, nitty gritty conflict with the IRS, but the EA is representing the taxpayer with that same full authority as a CPA would have. No difference.
Exactly.
But here's why I make such a distinction between EAs and a accountants. Accountants aren't tax specialists. They may be tax specialists, but merely saying somebody is a certified public accountant doesn't mean they have the knowledge or the experience to prepare accurate returns or represent clients before the IRS. Whereas enrolled agent, many enrolled agents do accounting work, but they are primarily specialists. It is a tax credential.
I agree. And you look at a CPA, they really don't really get into the specifics in tax until they're really practicing, whether they're working for a firm or they decide to take the risk and open their own firm. They go through all these problems. And we have a big community in the tax world, actually, whether they're an EA or a CPA, we're all connected nationwide. And that's the beautiful thing I like about the tax community is we all like to work together. It's really different than any other industry where everyone's competing against each other. That's because I think everyone knows it's a dying industry and everyone has more than they can get in terms of clientele. But when it comes to the main difference, I think EAs can get off to a great start from the examination, but really it doesn't end there. And I think I would say that for any profession where just because, you have a much more rigorous tax exam, it doesn't mean that it stops there. I think the value in becoming a real tax expert is the continuing education, is the real dedication of wanting to know not everything, but to be a real specialist in whatever field it is, whether it's real estate, whether it's corporate tax or anything like that.
Brings us to the CRETS, the Certified Real Estate Tax Specialist designation, says is that you have specialized expertise for anybody who owns real estate. So it could be a full-time investor who's managing 20 or 30 or 40 different properties, or it could be somebody who works a W-2 job, looks at their 401k, says, I want to get some diversification, decides to buy real estate outside that 401k. So they're going to need some specialized help. They need more than they can from the local H&R Block if they're going to look at depreciation issues for a short-term rental property or something like that. Before we go on to talk about your book, though, you said something that piqued my interest. You said industry. Tell me about.
I'm honestly shocked that a 26-year-old like me can come in and whether it's write a book or become a tax planning strategist, even though this is a career change for me. A few years ago, I wasn't anywhere in tax. I was an engineer. And I'm honestly shocked when I go to seminars, I travel across the country to see other EAs or even CPAs and do all the seminars and everything like that. And I have
Be this guy any room.
I think by 20 years, honestly. It's not that I'm the youngest, it's that I'm the youngest by a big margin. Definitely way under the average. And I'm shocked by it, honestly. I don't know why more young people don't want to do it. I think they just don't know anything about the enrolled agent license. I don't think they know what they can do in this field. Now, the information and learning everything can be a bit tolling, but I think there's a lot of value in getting into this space. And as much as the AI talk is coming in, I don't think at least the tax planning strategists or the representation, all of the EAs and CPAs representing taxpayers in front of the IRS, I don't think they're going anywhere with AI, at least anytime soon. That's really more for the basic preparation. But it's shocking to me, honestly, how more people aren't coming into tax and they want to work for a firm and do auditing or something relevant like that.
It's interesting because within the financial advisory field, there are more and more financial advisors who are moving into tax planning. They're doing it because nobody wants to talk about life insurance. Nobody wants to talk about investment portfolios. Clients in general look at the financial advisory world and everybody looks pretty much the same. So the financial advisor is talking about tax planning. Well, the financial advisor has something different to talk about. He's got something to talk about the clients want to hear about, as opposed to something that they need to hear about. So the older enrolled agents that you meet and that you work with in these meetings, are you finding that for them it's a mid-career change, or are you finding it's a generation of people who started as enrolled agents your age? We're just replacing them with younger people.
It is definitely a mix of both. I feel like the older EAs are what you said, where they've started as an EA maybe because they're a second gen or third gen firm owner, and they just continue because maybe their family did it. And I have also met many people who've transitioned, whether they were accountant or even outside of finance in general, where they go into tax and they learn from scratch, whether they're middle-aged or maybe even older. I've met people older too that have transitioned into this career. Actually, physicians too. I've met physicians who've
Wow.
transitioned into
Of course,
tax.
because they're the ones who've been paying the taxes
Oh
for the
yeah, of
last 30 years while we're earning their
course.
physician incomes.
Yeah, of course. So you meet all different kinds of people, and I think that's a great thing where you know where everyone's coming from. Even some of the industry leaders that I follow, especially for continuing education, I know someone who was in higher ed teaching, and he is now one of the leaders in tax continuing education, at least for enrolled agents, but I would say overall among EAs and CPAs across the country. So anyone can really come from anywhere and do tax. But the problem is, it's not all about just doing tax. It's really a specialty, and it's really something that people need to be technically an expert in.
Sure. So you have established some expertise in the real estate area. You've created some authority for yourself at a young age. Let's talk about the ultimate tax log. This is where you get to plug your book. You have a copy of it in front of you?
Yep. Here's
All
my
right.
book, The Ultimate Tax Log. This is a great tool for any taxpayer to beat the IRS in your tax audit. This is also great for any advisors as well. In this book, it's not just a simple log. As taxpayers, whether you want to claim a real estate loss through a short-term rental strategy, or even add some of our favorite strategies like equipment leasing when it comes to material participation, this book is not only a log, but it explains the rules on how you can qualify to beat the IRS in their audit when they want to audit your time log and they want to audit and make sure are you really following the rules as the way the law is written. I feel like the law is very outdated because the law requires everyone to write all of their time logs, record their hours, like as if you're an employee at a job where you're putting in your timesheets every week. That's what the law really says. And this book really explains all those rules in very plain English, and also has all the citations, and also has real world tax court case examples. So I feel like this is a great book for anyone, whether they're a real estate investor, someone getting involved in some certain tax strategies like equipment leasing, or even any real estate tax professionals, or even if they're not a real estate tax professional, if they're just a general tax pro and they want to learn more about these rules. The problem is there's so much advice online, and it's so hard to find each exception to the exception because maybe one article is talking about one thing, but they're leaving out something else. This is a great book to pick up and really read and get a really solid understanding on what the IRS is looking for. And even if you disagree with the IRS, you go to tax court. This is a fantastic piece of evidence that you can submit to the tax court. And when they pick this up and they see your handwritings in the book and they see all the rules there that is being cited, I think this is a great opportunity to secure your tax deduction and really take home the money that you deserve to keep.
So let's talk about one clarifying thing. The subtitle is How to Beat the IRS in Your Audit. Don't wait until you get an audit notice from the IRS to buy this book. If you wait,
Exactly.
if you wait until you get the audit notice to buy the book, it's already too late. This is a tool that you will use. Let's say you decide that you're going to buy a short-term rental. You're working as whatever you're doing for corporate America or the government or profit. You're making nice income. You decide that you want to buy a short-term rental because you want to be able to deduct those losses against your ordinary income. That's something you usually can't do with most residential or commercial real estate. So short-term rentals fall within specific exception to the passive loss rules in code section 460. I threw that out just to impress Neil that we can throw the code sections around like that.
I have no idea what code you're talking about.
Of course, of course, of course. No, we're just geeking here, but there are some specific rules you have to follow in order to do that. And you mentioned, Paul, material participation. And you need to document them as you are managing your property, In most years, this book is insurance policy because you're going to get audited. The overall audit rate is less than 1 out of 200 taxpayers. Audit rates are falling. IRS resources are falling due to budget cuts, and various other factors. Inside the IRS is a hot mess. It's a hot mess. So the odds that you're going to get audited are pretty slim to begin with. But if you do get audited, you're going to need to be able to show the IRS that you met your hours requirement. And this is really where the rubber meets the road. You can watch an endless number of videos on TikTok or on Instagram saying, here's how you eliminate your tax. You buy a short-term rental, you do a cost segregation study, you write off the personal property using depreciation, it'll offset all of your income. Social media is not the real world, and you need to be real careful about those claims because in most cases, it's going to pencil out. And if you use short-term rentals to zero out your income every year, pretty soon you'll be able to convince a bank to give you the money to buy more short-term rentals. It's going to be bankable. But it's a common goal. So tell me about the material participation rules. Tell me what a taxpayer has to do specifically. They have to be able to prove it to the IRS in the unlikely event that they really do get it.
Sure. So let's take a short-term rental, for example. The rules are if you want to claim the depreciation losses, the goal of this is to turn those depreciation losses and offset that with your active income. It could be your income from a W-2 job. It could be your business income, whether you have a practice or a firm or anything like that. To meet that goal, there's 2 rules. The first rule, as you said, the exception from Section 469, you have to keep your average guest stay throughout the year at 7 days or less. That's all of your guests. Hopefully, on average, they're at like over a weekend, like 3 days or 4 days or something. And that's throughout the year. Now, the second requirement, which gets everyone, is you have to materially participate. Now, in the IRC, it says it has to be a regular, continuous, and substantial activity. But in the Treasury regulations, where things get really complicated, there are technically 7 different ways to meet this test to qualify as materially participating in your short-term rental property. Now, the most common...
The Internal Revenue Code, regular, continuous, that's pretty vague.
And I would still argue that the Treasury regulation is still pretty vague, but the Treasury regulation gives you 7 options to materially participate, but really the easiest option is to work 100 hours regularly, continuously, and substantially in your rental property, and to make sure no one else in your short-term rental business is working more than you. So for example, if I have an Airbnb and it's, let's say, a couple hours away from me on a lake or something here in Michigan, I can go and do some renovations throughout the year. I can do some paintings. I actually have some rentals and I've done that myself, and it's a lot of fun. Maybe some flooring or anything like that, or even working with the tenants and collecting income.
I thought tax was bad. Maintaining a short-term rental doesn't sound fun to me, but we all have our preferences.
Exactly, yeah. And let's say I want to hire a cleaner in between the guests. Now, throughout the year, I have to record my hours to make sure I hit the 100-hour mark, and I have to record the cleaner's hours to make sure that they don't work more than me throughout the year. So for example, for example, if I work 110 hours throughout the year and the cleaner works 120 hours throughout the year cleaning my short-term rental property, I would not materially participate. I would be disqualified from taking those losses. So I have to really make sure that I'm recording their hours, first of all, because people often forget that. And I also have to make sure that either I'm putting in more hours than them or they're putting less hours than me. So it can get very complicated, but I advise everyone to just keep it simple and do what you can for the first year, because you don't have to do this every year for that specific property. You only have to do it for the first year to claim the losses. And then for the following years, you can set it as a long-term rental, short-term rental, doesn't matter. You already took the loss. So you can't just take the loss.
I'm understanding now the word that's a loss. That's how you're able to claim it. So you have to show that you've lost and you're working hard as can be. Why is not in other businesses, Paul? Why can't you say, I'll just create another business? Let's say, okay, I have a marketing business and I'm going to go ahead and say, I'll create a tutoring business, but I'll make sure it's just a loss. Would that be capable of doing something like that?
The key thing about real estate losses is they're not real losses. They're just paper losses. Because what I'm doing with the short-term rental loophole, for example, is I'm advancing all the depreciation into year one. A lot of people have heard of bonus depreciation. Now in the big, beautiful bill, it is 100% bonus depreciation permanently. So a lot of people raised their eyebrows and said, time to take advantage of the short-term rental loophole again and really get into any kind of real estate tax strategy. That's why it's so popular. And that's why you hear short-term rentals so much, is because anyone can do it as long as they meet the requirements. But the
So
real
this
loss,
this
sorry,
goes
go
all
ahead.
the way, yeah, this goes all the way back to the 1980s and the tax reform of 1986. Real estate is a specific line of business. Real estate is like a marketing business or a tutoring business or a tax planning business or a podcasting business. Real estate is treated as a passive activity. And what Congress was trying to do was combat abuse. People would go out, if you bought a property, you put $1 and you borrowed $1,999, you would have $1 million depreciation deduction. Now, you might be able to deduct that $1 million all at once. With bonus depreciation, there are pieces that you can deduct all at once. So what you had was people who were taking real tax losses against their ordinary income on money they hadn't spent. So Congress clamped down on real estate specifically. It's been expanding the rules for real estate ever since. In 1993, they created something called real estate professional status. The short-term rental rules have become more popular as people have realized, well, I make $300,000 a year. I bought a property, $20,000 in depreciation, non-cash losses, but I can't take them because of the passive loss rules. So the first exception to the rule is short-term rentals. Paul, you talked earlier about the exception to the exception. So the general rule is no losses on real estate. Short-term rentals are the first exception to the rule, but the material participation becomes an exception to the exception. It's like this Russian nesting doll collection of rules, and pretty soon somebody's got to create something called a certified real estate tax specialist to help people make their way through it, because the people who talk about all of your income on Instagram really aren't talking about material participation. They're talking about cost segregation, which is one piece of the puzzle, but they're also talking about just the daily blocking and tackling of keeping the law, being able to prove it all when you do end up in audit. I mentioned real estate professional status. If you can also be a real estate professional if you participate in more than 750 hours. Those 750 hours are more than 50% of all your trade and business activity. I'm already losing people here. I don't understand this. For a lot of people who are watching the Lyon Share, I'm already losing. But the IRS is, if you claim real estate professional status, the IRS want to see your logs.
Right.
They want to see how you spent those 750 hours. If you're sitting up the night before the audit going through an old calendar, you want to have 3 or 4 different pens. You can see that because in an audit,
And maybe a couple of different people to write it in too for some different handwriting.
Because I have defended a client at an audit for real estate professional status where I brought in 3 years of a day planner. Remember the old paper day planner from 20 years ago? That's a whole lot harder to prove now with electronic records. That's where the real value comes in for your book, Paul, is we can talk at a level about short-term rentals as a tax-saving strategy, and that's great. The devil is in the details, and we really do have to talk about how you substantiate that stuff, because if you show up at an audit and you watched an Instagram, watched a bunch of TikToks, the auditor's not going to be impressed. Okay, how many hours of TikToks did you watch? And I know kids who can watch a lot of TikToks, but it's
no doubt.
not enough to say that you watched a bunch
Oh
of
my
TikToks.
gosh.
So
No.
you have to document all of this.
And
that's
it's interesting what I've learned, Ed, from this conversation is I didn't even know about the short-term rental thing. And that's the thing of why you need a professional, because you're going to get these great strategies. And there's scam artists out there, as we talked about on one of our podcasts, where listeners wrote in, Ed, that basically there's a lot of scammers out there going to give you these dreams so they can get your money. And
Right.
they're in every industry right now.
Oh,
And
yeah.
they're rampant because of the international now, or somebody saying they're from somewhere else. And you just got to really go to the top professionals and get a consult before going and making the move.
And even if you hear about the short-term rental loophole, you see it online or something, and you think, I can do this without knowing the full details, you go and buy out a rental property. That's a big investment that's pretty hard to liquidate. And then after a couple of years, you find out that your losses have been disallowed, or maybe even you didn't even know about the loophole or didn't know how to claim it properly. You have this big asset and are stuck with it. It can really hurt people.
There are other pitfalls as well. Spent the week of New Year's on Antigua, delightful island in the Caribbean, and I've thought about buying property there, which would be great. But can put property on the platform, on the Airbnb platform, there who's cleaning the property, one who's making a service call to property, sitting home in Cincinnati, Ohio. There's a real chance they may participate more than any other individual in that activity. But here's another problem. Let's say I decide that I want to spend some time in Antigua. If I spend more than 14 days in my short-term rental, or more than 10% of the rental days, guess what? It's not short-term rental anymore. It's a personal residence. If I stay 15 days instead of 14 days, I've turned it into a personal residence. Depreciation deduction, gone, just like that.
Now, an exception to that rule, which is where exceptions come in, is if you can go and work on the property for some way, somehow, that will not count as one of those personal days, and you can still bring your family. You're totally entitled to do that. So getting a strategist, honestly, can really help you out there. If you want to enjoy your own rental property, and you can schedule some work out there so that you don't have to get stuck with that personal loss limitation.
And so that's why I talk about the book as an insurance policy. You buy a short-term rental, and there are various other strategies that are covered in the book. So if you own a business and you're taking advantage of the Augusta rule, or if you own a business and you have a home office, these are all scenarios that are covered in the book. If you buy a short-term rental, odds are that you are going to get audited. Odds are it's going to be a problem. $40 that you invest in buying the book, the time that you invest in log all of these activities, think of that as an insurance premium. When you buy the short-term rental, you're going to need casualty insurance on the short-term rental. You have car insurance, you have homeowners insurance, you have renters insurance. Paul, your book is tax deduction insurance.
Exactly. And ideally, you fill out this book throughout the year. It's not really meant to be a read it and put it on your shelf. Really, you're using it throughout the year. I know plenty of people who are real estate professionals who still do it by hand and by a book or a journal or something. Now, they take this with them everywhere they go when they work on their rental properties. Ideally, you use this book for all of 2026 right here. And then once 2026 is over and filled out, you store it in your shelf, and you just hope will be the one time where you hope you get an IRS audit. You hope to get the IRS audit and just simply hand them the book. And then
No, you're going to have to create a workbook next. People that bought the books, you have the workbook.
It is a workbook.
Yeah, the law is also in here as well.
So you're hoping you're going to have a 2027 one then too.
Oh yeah, every year there will be a new version.
There you go.
It's not stupid. He's hoping to lock you into his annuity.
Yeah.
So you're giving all your clients that for sure, right? You're not. That's part of
all of my clients who need it. Of course, it depends on the strategy, because at our firm we do have custom tax strategies for each client. So it might be not applicable to some clients, but to others who claim the real estate professional status, short-term rental, or any other business that needs a material participation, and most of all, the Augusta rule. Really, everyone talks about the Augusta rule, but no one really knows why people fail at the Augusta rule. So
again, the Augusta rule is it's all over TikTok. It's
Right.
all over Instagram. It's a really cool rule. You can rent your house to your own business for up to 14 days a year. You can write a check from the business and deduct that check from the business income. cash it, pay tax on the income. The devil is in the details. 2 years ago, there were a couple, was it 2 years or 3 years ago? There were a couple of tax court cases that looked at clients who had used the Augusta rule. They did their I's and cross their T's. In one case, they lost their Augusta rule deductions completely. In another case, they lost most of their deductions because you've got to establish what the house is worth. You can't just say the house is worth $10,000. You've got to establish what it's worth. You've got to document the business use, have a law, a list of everybody who attended the meetings, the receipts for the stocks that you serve. All of that is
Exactly. Wow.
Again, it is tax deduction insurance.
And those two court cases are actually in this book so that normal people, you don't have to be an expert in tax. You don't really have to know anything about tax. You can read those court cases and really understand why people lost their deduction. And the beautiful thing also is there are very specific instructions in this book on exactly what to do. It's already laid out for you, and you simply just have to take a pen and fill it in, assuming it's in good faith, and you'll be able to sustain your deductions.
And what that does is gets rid of the fear of an audit.
Mhm.
Most Americans live in fear of an IRS audit. They think it's the worst that can possibly happen to them. I've defended audits. I've been audited myself. It's a chance for the IRS to take a closer look and see if you really are entitled to the return that you send to them. But when you have a resource like this, you'll know what the rules are, understand the rules, you understand what you're doing, why you're doing it, why it's going to work for the IRS. When you hand the book to the IRS auditor, they'll have scheduled a couple of hours for the audit, but they'll look at the book, and in 5 minutes, they don't want to waste their time any more than you
No.
want to waste your time. So it removes the fear from the process. It's so tremendously powerful and tremendously liberating for people.
It's definitely powerful. And I think that this, again, Ed, the people we bring on the show, this is absolutely what people need, especially if they're in the real estate game in some sort of way to work with Paul. So, Paul, you work with all different types of real estate professionals that own properties, manage properties, and varies. And real estate is the biggest get rich quick scheme out there. So there's tons of people that have gotten taken to the cleaners with specific things and then come to you and say, Paul, please help me.
Tax savings is a big part of the real estate investor's ROI. If you don't consider the tax savings, really, it's not really a get rich quick scheme. They can really either break even or even lose money if it's a bad deal. There's plenty of things that go into it. And it's not really limited to only the real estate investor for rentals. Even any business owner who decides to purchase a building, there are plenty of real estate tax strategies to apply to, like doctors who want to buy their own medical practice or medical office, any law firm who wants to purchase a building, anything like that. There's plenty of strategies out there for them to take advantage of. And these rules would also apply as well.
We're talking short-term rentals on this call simply because it's an example of what needs to be documented, and it's a particularly popular example on social media of what you can do with tax planning. There are all sorts of considerations you need to look at. The people who make the most money in real estate are the ones who buy and maintain it for decades. In most cities in America, the richest families in town, the people can trace their real estate back generation after generation. And there are all sorts of factors and danger zones. For example, I was in Antigua for 4 nights. I rented an Airbnb, but if I were in New York City for 4 nights and I wanted to stay in an Airbnb, I can't do that because New York City has regulated against short-term rentals under 30 days. Barcelona in Spain is a really popular place to visit, but there were so many people who were offering short-term rentals in Barcelona, took housing off the market. So these apartments, instead of housing the people who actually live in Barcelona, make the economy hum along, had been taken off the rental market for Barcelona residents, and they were being given to the tourists. So Barcelona said no more short-term. A lot of places in this country have made that decision. That's a risk factor that somebody needs to think about before they do a short-term rental. If you live in New York City or one of the other cities that has banned short-term rentals for 30 days, if you want to buy a short-term rental, it's going to make it harder for you to meet the material participation requirements because you're going to have to travel to manage the property. There are places where you're going to be able to DIY it. If you're doing all the management, all the cleaning, all the maintenance yourself, you're going to have a problem meeting that 100-hour requirement. But what happens when you decide you diversify your portfolio? You live in San Antonio and you've got 8 Airbnbs. That's great. You want to buy an Airbnb in Dallas or maybe Santa Fe, or you've got all sorts of different considerations. It's not as easy as the TikTok videos would have you believe.
Even in the smaller cities, like where I live in Metro Detroit, a city called Rochester, Michigan, they even have a rule where you can't even have a rental that's less than 27 or 28 days or something like that. So you're automatically out of the short-term rental loophole because you need 7 days or less. So it's not even only the big cities, but even the smaller cities, like the one where I live right now, are starting to come along. You really have to do your due diligence and your research, or even consult like a realtor who specializes in this, who knows where to buy and things like that.
Awesome.
The rules can be picky. So you talk about rentals under 7 days, but what if I do 4 7-day rentals in a row on the same property? Are those treated as 7-day rentals? It's a single 28-day rental. I'm going to skew the average upward, and I may end up with a 7.5 or an 8.5 day average rental period. So and really, this is the topic I want to emphasize with Paul, which is there's very high level. Here's a cool thing that you can do to write off a ton of money against your salary. That's the TikTok version. What we're talking about today, when we're throwing around code section citations and the Simply decision, all that kind of stuff, you really do have to dig around in the details to make it all work. Paul, thank you for joining us today. Always a pleasure to have you on the Lyon Share Podcast. And it's not a glamorous topic, but it is really important. And if all you do is talk about the fun of the tax savings without the responsibility of reporting it properly, you miss out on the savings. So tell us once more about the book and where we can go.
Sure. The book is called The Ultimate Tax Log: Beat the IRS in Your Tax Audits. You can get it now on Amazon if you look up Ultimate Tax Log or my name, Paul Channo, Channo. The current paperback version is for $40. You can get a hardcover version for $60, and it's available even in multiple countries if you're traveling right now. That's my book.
It's cheap insurance. It's the cheapest insurance you'll ever get against a tax audit.
All right. And please share and subscribe to the podcast, the Lyon Share Podcast. And we appreciate our great guests. And thank you again, Ed.
Thanks.
All right. That was a special simulcast, The Neil Haley Show and the Lyon Share Podcast. Guys, take care.